next slide.
Yeah. I just want to I'll just go through the yeah, there you go. Let's start from there. We'll yeah, still people still ticking on one by one, so every second or so. So while we're waiting for everyone to join, thank you all the people that have joined at the moment. It's great to see you all today. We just a little bit of housekeeping just to start. We're going to run through. By all means, use the chat window to see what's going on. For example, I'll put a little thing there in the chat window, so you can see, if I can find it. Where's it gone here? And to all the panelists and the attendees. For example, here's the Protos Medium website. So if there's any issues or any links that we can post, Philip or Freddie or myself or Charles will post it there. Also the Q&A session. By all means, at the end of each of these topics, we're going to have a Q&A session for people to ask specific questions about that particular topic. And we'll also have a general Q&A at the end to, if you have any questions about DeFi in general. Okay, so I think, do you want to move over onto the next slide, Philip? Do you want to, it's now 15:03, so it's slowed down. I think we're pretty much getting to a full attendance now. So Philip, do you want to hand over and do a couple of introductions? I know we've got, I think we've got Tom there as well, haven't we, on the blank screen?
I think so. I don't see him, but if you see him.
Okay.
Shall I just give a round of introductions then, maybe?
Yeah. I mean, if you go to the next slide, you got let's see your pretty faces and go.
All right.
There.
Yeah.
And okay, go ahead.
So yeah, let me introduce the team, and thanks, Steve, for making this possible, and the rest of the team at Anglo Swiss. So my name is Philip Kallerhoff. I am the CEO and CIO of Protos Asset Management. My background is 14 years managing hedge funds with up to $1 billion with quant strategies and systematic strategies. I founded as well and sold an alternative credit scoring company called Jumaya to a US bank, and I did a PhD in computational neuroscience. Then Tom, who is here today as well, is our chief product officer. He invested in 3 out of 5 of the top 5 market cap cryptos at less than 5% current price. And he's the founder of the first crypto fund and first licensed crypto asset manager in Canada. And he created the first tokenized quant hedge fund together with me and Matthew Shaw. So Matthew is our co-founder and senior risk and policy advisor. He founded and sold an investment bank to DeFi for $250 million. And he has been over 25 years creating new financial products and managing funds at companies or banks like UBS and Gazprom Bank. Also today we have here Freddie Farmer, who is supporting us especially on the DeFi space, and he's bringing a wealth of knowledge with him from smart contracts as well as stable coins. And he joined us from Wintermute Capital in London. And we also have Patrick here today, who's helping us on the portfolio management side of the funds. So let me just go to the next slide, Steve, or?
Yeah, go for it. Yeah, go.
All right, so then I'll dive into the yield generation strategy that we're offering at Protos in this Protos fund. So first of all, I want to quickly introduce what is yield farming for those of you that are not familiar yet or not so familiar yet. So these platforms offer the opportunity, usually on a lending and a borrowing side. So the lender obviously deposits digital assets like us. So Protos is holding US dollar stable coins, posts them on these DeFi platforms, and then borrowers can request loans with collateral. The smart contracts on these platforms make sure that the assets that they are borrowing are always collateralized with over 100%, usually even 150%. And obviously the terms, which is, for example, or most importantly, the yield, that these assets will offer to us then, right? So then the yield comes back to us, and the borrower can receive these digital assets by collateralizing, for example, Bitcoin or Ethereum or other assets that that he holds in his wallets. So that's in terms of the yield farming. So what has been our performance so far? So on a gross level, we had a cumulative return of 32.5%, which and we're just 1 year into the fund right now. Actually 1 year, 1 month, but we don't have the latest number for November yet officially. But it's very much in line with our past returns. We had an annualized volatility of 13.6, and so a Sharpe ratio well above 2. And the monthly return is 2.7%, which is slightly above what our expectations were. And we do think those returns will go forward with something around 2% for the next year. Then we split up the returns per quarter. The first quarter was 4.6%, then slightly lower and up. And then obviously the last quarter going into October this year was tremendous of 21.6%, which was the main driver. There were the farmed tokens that rallied on top of the yields that they were providing. So, and I would just want to quickly compare us to the other platforms that you can use as well for if you have some stable coins lying around or even US dollars that you want to deploy. So Yearn Finance is offering 9.85% right now for providing DAI, which is a US dollar stablecoin. BlockFi is an interesting platform which is offering 8.6%. This is a fixed, so not Yearn Finance is variable interest rate, whereas BlockFi is a fixed interest rate. There are some liquidity limitations on it, but otherwise that's an interesting yield as well. And Aave, which is a very big platform as well, is running at 6.4% at the moment. So how did we outperform, let's say, those simple platforms if you just look at them separately? So what we are trying to achieve is a well-diversified portfolio with the best possible yields. So we do roll over into new platforms as they come along, and we will also want to mitigate most of the risks that that come from investing all in one platform, as well as not reviewing smart contracts and the audits behind it. So as you can see, our major positions are right now in Compound, which is obviously one of the longest running platforms, as well as Crypto.com. And then we have other platforms like Curve and Harvest and so on. And we do hold some positions in our wallets. So for example, we always hold some Ethereum and US dollars to pay for the transactions, obviously, yeah, Ethereum. And then, well, I called it DeFi here, the wallet DeFi 4%, which is essentially the farmed tokens from last month. And then we hold a DPI ETH position, which you will see on the right side is a very high yield position, but it does have market risk. So we're just using some of these farm tokens for some extremely high yields. Otherwise, on the right side, you see the distribution of yields, which is from last week. But like it's obviously variable, but very similar right now. They're about 25%. There are some outliers to that, which is empty set dollars, which was almost infinite yields. So I kind of grade that out, and it's also variable because it kind of jumps between a very extremely high yield and a low yields. Then KeeperDAO is also very high at a 40% level at the moment, and the DPI ETH is returning, or it was last week over 100% return, but this is also coming down obviously with time. So let me just jump into a couple of examples here. So this is the example from Harvest Finance, which is providing about 25% yields for providing Curve stablecoins. So the Curve stablecoin is again a liquidity pool of other stablecoins. So you're again, you can see that stablecoins are wrapped again and again and again. So in this case, anyone can participate in this platform, and the Curve token only is part or is made of other stable coins. So the market risk towards Bitcoin and Ethereum is first of all very, very limited. Then this Harvest platforms is compensating the liquidity provider with curve and farm rewards. So, and this is split up here on the figure. You basically at the moment you get 11.78 directly from in terms of curve tokens, and you do get 12.86% on top of that in farm. So if you would just leave your curve tokens on the curve platform, you would just end up with this 12%. So again, this shows that these platforms are all stacked now on top of each other, and that really generates those higher yields that we talked about and that we've kind of accumulated in the past. A second very famous example is Compound Finance. This is obviously one of the first platforms that we're offering additional tokens on top of the supply yields. So again, anybody can supply capital here in terms of, in our example here, DAI. This capital can be supplied both on the DAI, on the supply side and the borrowing side, and you have to make sure that the DAI is that you use the same currency on both sides in order to minimize the oracle risk. And so first of all, the way this works is that the user receives a supply yield of 3.46%, and then on top of that receives a distribution APY of 1.82. So that gets you to 5%. Then on the borrow side, so the way this platform works though is that once you supplied $100 of capital, you can borrow $75 against the supplied capital. So that gets you to 175. On the supply side again, you can borrow again and so forth. So ultimately, you end up with 4 times your capital on the supply side and 3 times borrowed. Why that is interesting, because you do get these distribution APYs on both sides. So your total or net, or like your actual APY is then 21%, because it's 4 times the APY you're getting on the supply side minus 3 times the difference between what you have to pay for capital. And in this case, so you have to pay 4.56, but you do get 2.26. So you end up with paying 2.3%, which is less than what you're getting on the supply side. So obviously, it's interesting to be on both sides of this capital market. So all of this is run through smart contracts.
So before we move on, Philip, we've got a couple of questions here regarding the compound exploit last week.
Sure. Okay.
Were you affected by the compound? Also the harvest exploit. We had 2 separate questions about similar issues on both compound and harvest. Do you want to look at that?
I mean, so the exploit is that all of these platforms are. So let me talk first about the compound exploit. That was all these platforms are really based on these stable coins, right? And if you supply and borrow capital in different currencies, then of course you are facing the risk of being you're facing a margin call. If you are very close to this to the margin. So, and the way to mitigate that is to supply and borrow in the same currency, because then even though the price of the assets changes, your ratio doesn't change, and therefore you're not facing a margin call from folding your assets onto compound. The second thing is harvest. So harvest, that goes a little bit further into the rabbit hole. The harvest exploit was that all of these platforms are relying on oracles that provide data, like price feeds to what a Y curve token is worth, or the 3 curve token is worth, or USDC and so on. And what these flash loan attackers used was not like a hack of the smart contract, where it was actually an economic hack, where there was a price difference suddenly between the Y curve token on the actual curve platform versus harvest. And they exploited the difference between the two, and harvest didn't catch that, because just 2 days before they were changed, or a couple of days before, they changed the price feed to be instant, and therefore only made this hack possible. And this is now being mitigated because they have now only used directly the Curve tokens instead of the underlying stablecoins. And then they have kind of split it up into the stablecoins, which are just earning just farm and no and maybe some compound tokens, but this is relatively lower, and this is not posted back into the Curve platform. So yeah, essentially, this is a lot around slippage parameters that we're monitoring very closely, and the oracles that are feeding the price data. So these are just two examples of the parameters that we're watching extremely closely to kind of mitigate those risks. And yeah, that's it.
Okay, good.
Okay.
Yeah, do you want to go?
Okay, so yeah, let me actually, yeah. So we just talked about smart contracts. So let me talk about the importance of risk mitigation here. So what we've split up the different strategies into 4 categories. That is yield farming, centralized finance lending, decentralized finance lending, and liquidity pools. All of them have certain risk parameters, and they have multiple platforms to be used on. So, and we want to basically optimize the yield over the given risk. And the risk we have split up into 3 major risks that we are seeing. One is the smart contract risk, secondly, the liquidity risk, and the stablecoin risk. On top of that, we are monitoring that we have a maximum counterparty exposure of 20% to any pool or platform. We want to limit our pools. We are limiting our pool size to 1% of the total pool, and we're watching the transaction costs so we don't pay high gas prices for small positions. Once these lower, let's say, parameters are set, we go into an optimizer where we want to optimize the yields versus the smart contract liquidity and stablecoin risk. So, and in this example here, we picked two ones. So for example, the compound yield farming versus a newer platform, Haka, which is a liquidity pool, which was at some point offering a very high yield. But on the other hand, the yield was higher than the compound yield maybe. But on the other hand, the smart contract risk was much higher because this was a fork of another platform, but not an exact fork. So there were much higher smart contract risk as this was not as proven. Secondly, the liquidity was much less than on compound. I mean, compound being one of the major platforms. And then the stablecoin risk was very similar to compound, as they were using DAI and UCC, which are obviously the 2 most prominent stablecoins as well. Then we go through, in order to kind of evaluate these platforms, we go through a code review, and we check not only the code, but also the economics behind it that are driving possible economic hacks, like the flash loans or other possible attack vectors. And then at the same time, we are screening constantly the different platforms and yields. And obviously, the REN BTC pool here, for example, has the highest, or at that point, it had the highest total value locked of 300 million. So you can already see that these are relatively large pools of capital. And again, we want to be 1% of those. So, in either of those, we would only take like compound is a good example here, 100 million in it, and we wouldn't take a position bigger than 1 million, for example.
Philip, just one question there on the smart contract. We have a question from the it said, what's the typical skill set needed to review and audit the smart contracts?
Yeah, good question. So basically, what is necessary obviously is a computer science background, being able to read the smart contracts and being able to read the code here, the parameters that are set. But just as well, you need an economic understanding of what these platforms are driven by and how they can be attacked from an economic perspective. So basically exploiting price differences, liquidity, that again then impacts prices. So it's a combination of I would say computer science and economics. Okay. Let me go into liquidity, where we see the liquidity and our strategy around it. So first of all, we're looking at a relatively or a very strong market at the moment. Multiple large VC firms are backing these yields. So, like if you're wondering why is Compound paying 21% right now, then this is clearly, Andreessen Horowitz investing, and they want to grab market share, as well as maybe, Polychain on Keeper DAO that want to push these platforms with very high yields. And that's basically paying for capital to come in. Secondly, we have seen the market grow dramatically over the summer. So while before the summer we were at like about a $1 billion market of total value locked, this jumped over to over 10 billion in less than 6 months. And the biggest platforms are still, Compound, obviously a big one, but then as well Uniswap, Aave, Synthetics, and so on. And the second thing is we're only looking at the whole market from a stablecoin perspective. So we only want to post stablecoins like USDC because that obviously minimizes the market risk. Essentially there's no market risk there. They're pegged to the US dollar. There are by now quite a few of them. There's the USDC and DAI, which are the major ones, the largest ones. But you have also like, Whitecurve, which is it's a liquidity pool essentially across even different ones. So that you're kind of combining liquidity. And you can see here in the chart that the volatility of these stable coins is really minimal, and they fluctuate in the plus minus 10 basis point range, depending on the stable coin and the time, of course. Yeah, that's it. Maybe just in terms of wrap up in terms of liquidity. So all these platforms are instant liquidity. So the platforms that we're using here, in these examples, they have instant liquidity, so you can literally move in and out in a matter of seconds. Obviously, you have to pay the gas fees, which are high, but otherwise they're extremely liquid. And on the other hand, we only use the US dollar stable coins to farm or to generate the yields, to mitigate the market risk.
On that, someone got to your gas question before you did, Philip. Do you see the gas fees coming down next year?
So yeah, there's obviously this huge launch of Ether 2.0 today. We're watching that with very big interest because that could really limit the gas fees dramatically. On the other hand, the space is growing, as you can see in this chart, from 1 billion to 10 billion. And if that, again, goes to 100 billion or whatever, then, again, those gas fees become an issue again. So I don't think, in general, for now, Ether, the gas fees have been going up and up and up, just because the space is growing. We do think that with Ether 2.0, those gas fees will come dramatically down again, which will be nice to draw in smaller investors again, because right now, really, you have to consider that this is really a space for ticket sizes of $100,000 and more for each of the different pools, right? So not only going onto one platform, but really into each pool, you will have to put up at least $100,000 because otherwise it's not really worth the gas fees. And but yeah, we do see that coming down with Ether 2.0.
We have a question from Yakov. Are you insured against principal loss? What are the insurance options here?
So what we are constantly looking at is the insurance contracts from Nexus. And most of them are very, very expensive still. We think that once they become more liquid and larger, then this will be a very good option. The most important is that we do, first of all, we do these code reviews. We work with a very large group of other investors together. And I think most important is we only use the largest platforms, really. So like we go on Compound, Uniswap, or other platforms that have hundreds of millions of dollars on it. We kind of stay away from very small and new platforms unless they would with test sizes.
Okay, we got a lot of questions coming in now, but I think maybe this is a general question for yourself, Tom, and Freddie as well. How do you see the yield generation market developing next year? It's a rather wide question. That's why I brought the other guys in as well.
That's good. That's a really good question, right? So first of all, okay, so we had, if we go back to our returns, I agree. Our returns, have been very good this year, or starting last year, November. And we do think that this return per month will come down with time. On the other hand, what we think is that this market is still at the very beginning of a new wave, and with new platforms launching, they will, like Compound, want to grab market share and therefore offer very high yields. So that will make that will keep the yields up. We think it'll be in the 2% range really for the next 12 months, and a lot of programs are still running, still have this horizon of the next 12 months. So we're pretty confident for the next 12 months.
I think just to add to Philip's point, I think functionally what you're seeing, so he alluded to it before in terms of where the venture capital is going. You're seeing a paradigm shift in the amount of protocols and new business models that can be built upon these networks, which whilst they have reasonable friction right now, we think that the scaling issue is actually going to be solved. Where these yields are actually being generated from, functionally is kind of more like a venture play. So in essence, these yields are being generated through the distribution of equity-like tokens of a form, not securities as such, but a new business model. And I don't see the wave of new business models being built upon this new platform slowing down anytime soon. So it really depends functionally where you want to be investing. Like you can sit both on the venture side early and try to earn network share, or you can farm per se, which is actually just prioritize the yields afforded by not partaking in this future. But yeah, I don't see that changing. I think we may see more elaborate ways in distributing tokens coming out, changes in models of how those tokens that are being distributed are handled. And we're seeing that in active governance. And I think we'll also see different tranching of risk. So we'll see different kind of structured products coming out, distributing risks associated with various buckets of exposure to certain protocols. And insurance, I think, was the one someone mentioned about a principal assured. This is very new stuff, but ultimately the amount of insurance protocols, crypto native, that can bundle insurance products with the positions you're taking, that's kind of that's the new focus of a lot of the people building in this space right now.
Philip, do you want to take Yorgi's question? How do you handle the regulatory aspects like KYC, AML, when admitting members into the fund?
Yeah, so that's obviously handled by the fund administrator. We have MG Stover for that, which is one of the most prominent administrators in the space. So the whole KYC AML process is outsourced to MG Stover in the US, and that they're handling the KYC AML. Yeah.
Okay, good. The next question: who is your target investor?
Yeah, target investor is obviously, on the one side, funds or family offices that have cash lying around that are looking for yields. We want to offer a solution which is easy to plug in. You come in you invest in with US dollars. Sorry, excuse me. And we want to provide a yield on those US dollar, which is well above any kind of government bonds or even peer-to-peer lending platforms in the traditional finance space, but something that is very unique to crypto, and that will So that's we're really looking for institutional investors that want to deploy a US dollar to earn yields.
Gebo's question has switched from open to answer, but I'll just read it out anyway. It's the last question on the. What is your understanding of the main draw? Oh, Freddie, you're going to take the answer now. Go ahead, Freddie. Sorry about that. I didn't see your answer at the bottom.
No, sorry. Yeah, I didn't realize that. There's a recording if you're not doing a time. But I'm happy to give my short-term view, and then also Philip.
Do you want to read out the question first, Freddie, and then?
So the question was, from our understanding, what are the main drivers of the relatively high borrowing rates that we see now, even though a lot of these DeFi platforms are over collateralized. So that might be like a borderline inefficient way to borrow. And then it also says, what do you expect in the medium term in light of rapid and constant increase in TVL? I'd say with respect to the increase in TVL, this just shows the liquidity sink and kind of a Schelling point for capital that these blockchains effectively, once you remove the ability or the need to trust the transfer of your assets or its location, or it's all fully public, I think TVL will be a metric that we'll see just continue to balloon. I think with respect to the high borrowing rates, these are functionally high for a couple of reasons. My prior experience was a quant algo shop, like a proprietary trading house, where we just traded our own capital. But in order to remain delta neutral to the space whilst trading these brand new tokens, these are often first available on these decentralized platforms before they're available centralized. And that's just akin to how easy it is to add them to the platform. And so these high borrowing rates are functionally basically the ability to borrow this new asset and trade it as inventory, or the ability to earn recursive leverage on a more venture-like play that you're willing to stake your capital in.
Yeah, I think the only thing to add is, like, okay, high borrowing costs, what are they, right? I mean, and if we go back to Compound, for example, here that I pulled up is, the borrowing rate just outright is 4.56. So that's obviously higher than maybe, you would get from a bank for let's say capitalizing your house or something. But on the other hand, at least, in most markets, but on the other hand, I don't think that's a very high rate itself, right? So yeah, I mean, rates are pretty low, and the only way, I mean, and Compound is a good example, right? You have to be kind of, you have to fold your positions in order to get really 20% plus yields. Okay.
Okay. There's no more questions online now. So what I'll do is, I think we're almost, it's pretty much on time, 30 minutes. We allowed 30 minutes for the question and answer session. That's good. What we'll do is, as soon as the meeting is over, we'll wrap it up, the recording. We'll put the recording online, send it to all the attendees. And obviously you can follow up with any questions there for Philip, Freddie, Tom, and ourselves. And we hope that if there is a question that we didn't cover for you, by all means, give us a ping, and we'll speak to you all very shortly, I hope. Okay. Any closing comments, Philip?
No, I mean, really appreciate the time from everybody. I hope this was good news for everybody.